Volatility is back. Volatility is back. Doesn't look like it's going to decline anytime soon. Mr. Market is telling us that. My name's Jay O. Welcome to Jay's Corner. It's March 9th, 10 a.m. Sunday morning. I'm going to try to make this the time slot here. It's the time when I have, peace and quiet, relatively speaking, and able to review things for you. Things that are noteworthy, newsworthy, things to help you deal with financial uncertainty. We've got financial uncertainty now, and I just want to point out a couple of things here before we get started in earnest. As always, the Substack, the newsletter, Jay's Corner newsletter, jo.substack.com. The link is in the text below my image there. Please go and sign up for it. There is a paid version. The paid version, you get extended look at all the prior breadcrumbs that I've left on the widest variety of financial topics. And in addition to that, there are videos and other articles which are specifically for paid subscribers. The reason for that is that, I try to make these videos and the information widely accessible. That said, please understand I'm the highly regulated and need to be very careful, very careful. And I try to do that. That all said, the fact of the matter is we are dealing with a world where politics and he said, she said are rampant. This is jo.substack. This is my private website, jo.com. And when I go down here and think of what I think about my work, what I'm trying to do is say yes, accept that money is complicated, that there's a lot of confusion due to wording. And, I'm, of course, always doing my job that I have to do. I'm regulated to do so. I need to sleep. And then, in addition to that, very importantly, is I'm trying to make it very clear that I'm not here to debate philosophy and I'm not here to debate politics. I'm trying to deal with the world that we have, not the world that we hope for, because I realize that what you hope for may be different than what your neighbor hopes for. I'm trying to deal with the facts as they are. And along those lines, just yesterday, I released this video here, which is a winning money mindset, which will apply to everyone. And here I draw the analogy to a poker hand by world-class poker players, and so many lessons, so many takeaways that you can get from really just a 5-minute segment, which I clipped for you. And then I made my own comments around it, things that you can take away. You don't even need to know how to play poker. You could be like completely uninterested. If you know what the topic is, you'll be able to get the takeaways. My point here to you is the following, which is that in everyday life, we have knowledge. The entire platform, Maximize Your Medicare, this Substack is built on the idea that people do have common sense. They have encountered situations. They've used their common sense to survive. And yet, what happens when it comes to money, when it comes to understanding about finance, what happens is they throw they throw away the logic. They throw their hands up because they give up. They're overwhelmed by the language and partisanship and politics that are going on here. All that just can be only negative to you. So I'm trying to ground ourselves so that we can regain confidence irrespective of your financial or educational backgrounds. Okay, on to the show. So the headlines are fast and furious. And last Sunday, I talked about this, and this is I copied kind of what the agenda was and the topic list from last week here, and explained to you about how we think macroeconomics how people think about the general size of the economy. And these are the inputs, and I'm not going to review them. You can go to the video after you're done today. Please don't click there now. Consumption, investments, government spending, net exports. And last week, what we had was a bunch of headlines, as many people know, regarding government spending. And what this was U.S. aid. You've had also a lot of stories about layoffs, the temporary employee layoffs, as well as government layoffs. The point being that government spending is going to be pushed down, and that had to be replaced. This week, exports, tariffs. The point being here is, and I reviewed it here, that DOGE means much lower government spending. I'm not here to settle the politics of it, but now the question becomes the lag time. Because as you can see here, tariffs here in the long run may help investments, may help net exports. You can remember big announcements. Apple CEO, Oracle CEO, Open ChatGPT CEO, saying big investments in the United States. That's what they mean by investments here. Now, the tariff portions specifically are talking about exports, right? In other words, the cost of the things that we buy here in the United States are going to have price increases. The companies are going to face these increases. Whether or not they're able to pass them on to consumers is yet to be fully seen. We don't know the full extent yet. This creates a lot of uncertainty, right? Because now the question is, and if you go on TikTok, once you're done watching Boston Talk, the point here is that the candid reality is the lots of the stories of pain that you see on TikTok and social media is because some people just simply can't afford to wait. That there's going to be this lag time. The issue is whether or not people can wait. What's different now than pre-election, right? Food prices going to be dropped on day one. Is that now the messaging from the administration is different. And you can see it. That they've pivoted to no pain, no gain. That the tariff brings, and here's the issue, is the president admit and aides admit that there will be hitches but keep plowing to go ahead. And so now that opens the question about this thing that I've put here in yellow last week. We're going to get to financial markets and the uncertain headlines that you read. But the reality is here, I didn't have a crystal ball, right? But the logical conclusions were just simply logic which were not complicated. If you just connected dots, you're going to see here that I've got date and timestamps here for the things that would have told you that it's going to be uncertain. Almost for sure. We got it. Now, the reason, I still don't have a crystal ball, and I'm still not predicting, because no one complains when uncertainty or instability is higher in your favor, right? Nobody complains when volatility is prices of your 10 shares of Google are higher. Nobody complains. You only hear complaints when lower. And now it's too volatile. But let's just call it uncertain. And so you can see, and not coincidentally, on the website or on the newsletter, you'll see something that looks like this. Little diagram that I always try to include for people. In other words, nobody said, unidirectional. It can go up, it can go down. Meaning all sorts of other analogies, right? You could be right, you could be wrong. Uncertainty can create a situation where you are wrong. Oh, by the way, a central point to this video here. On and on we go. We're certainly there now. And then when you keep going through time, now you have here. And now other people have seen slogans, sayings on the newsletter that I try to remind people. We're at the red arrow. And now you can see the other, sayings that I try to make clear and why. Start where you are. We are here now. You can't look in the past to get some idea necessarily about, predictive power about what's going to happen next. We just have to deal with the situation as it currently stands. On we go. And for that, I'm making these following suggestions when it comes, and you can understand financial planning then becomes complicated. This portion here, I'm going to spend a few minutes, which is when someone asks me in my professional life, a certified financial planner, thinking about or reporting to them what my assessment is about their particular financial setup given an uncertain background, I ask them first, tell me how much stuff is going to cost. And one of a very, very short video on the YouTube channel, please like and subscribe. I'm terrible at doing that. But the point is that just two simple questions, right? Tell me who you are. Tell me what you want. Because then you're telling me, okay, now we can talk about how much does it cost, right? You need the newest phone. You need the newest pair of shoes. You need the newest fashion, etc. Right? You're telling me how much it costs. You tell me you're Mr. Perfect, never been sick, Miss Perfect, never been sick, never had a can of beer, don't catch a cold, nothing. You're telling me who you are, right? Because now you're telling me how long I have to think through. You're telling me how long is your specific timeline. And you can see this on other videos, and I keep referring back to other videos because I don't want to be repetitive. But for newcomers, you can know that this is not our first day. This is not our first day. There's a lot of information here on the channel as well as on the newsletter, which is I'm looking through this through time. We can just change the age and it doesn't really matter. All the attention goes to baby boomers, right? Lots of the nation's wealth is stored in the savings, whether that be in real estate or investments. But the reality is this doesn't change too much here when you're 40, when you're 35. We are still looking through here. We just have to have longer projections as far as time goes. When you're 60, now it comes different. And the point is from here, then the solutions follow. Plan first, solutions follow. I promise you to be consistent, right? In other words, I'm leaving you individual elements. We can't have all of the elements in one video. There's just no way. That's a 20-hour video. No one, people, we barely have attention spans beyond what? How long's TikTok? 1 minute. So you can see here how all these pieces and how I'm trying to build for people some intuition. Process is probably overused word, but how to think through, how to get this winning mindset so that you can think through this. And if we return back, which we will do here, now you can tell me, now you understand. If you know how much stuff, how much the projections are going to be, then you can work backwards. When I go through this timeline, I'm like, tell me how much this stuff is going to cost. How much do I need? That depends on your, like I said, your health. How long do I have to plan? On average, we know there's going to be error, right? We know there's going to be error, right? We're not going to be right 100% of the time. And for different people, it's going to be more or less volatile, right? Mr. Perfect, there's not a lot of big swings here. You have type 1 diabetes. Your blue curve over here is wide. That's just a medical fact. I'm not a doctor. That was my late father, right? But you know this, right? Complications to particular health situations are wider. Some are just contained, in which case you can easily deal with them and doesn't really affect you. And whether or not that blue curve down there at the bottom is flatter and wider in your individual situation. You can see it here. Each one of these points works back to this because it really does give you insight on everything. It tells you the number one question, do I have enough to retire? Can I stop working today? I don't love my job. I stay working in order to keep my health insurance for my spouse who's not yet Medicare eligible. Crazy people write books and comment like multiple hundreds of times and multiple hundreds of hours about Medicare and health insurance. This is why, because I'm talking about how much does it cost? How much do I, and since that's the big ticket item and can swing around in amounts the most, it's not because I'm trying to sell you an $11 book. That's why I wrote an $11 book. It's not the reason I'm trying to sell you the book. It's about so that you can come up with how much does it cost. The reality is this is not always negative. It's simply not. This can be that you may have overestimated and over worried about this timeline. And here's one here, right? And here it is, health related. I leave it as a separate item. I've talked about it extensively. There's a whole extra channel. There's a book. For some people, that tells you about what your career path has to be. Because now you're 40. You're 40. You go through this. You go through these steps and think through this in a stepwise timeline way. You realize, you know what? I'm behind. And I'm not in the camp of we have a crisis. We don't have a specific retirement crisis. We absolutely have a knowledge crisis, right? In other words, the uncertainty here is here, which has to do with knowledge. This has to do with fact here. Right? This has to do with this part. My point is that we're uncertain about this stuff here. Right? Because this is just the result, to be candid with you, right? This is not really, this is just the result. This stuff here is the point of the newsletter, is the point of all these videos, and me trying to imagine and create different ways for you to understand the logic, because we do have a knowledge crisis. And I encourage people, you can send me your individual questions. I even have my email there in the text below my picture. It extends to every element. And what I've left this out, right? For example, oops. There are other financial products to fill other functions. If you understand how your timeline projects to be, we know this is going to be wrong, but we need a starting point that some people will conclude they need to be more aggressive about getting the most out of their career. Right? The idea, and in the coming week, we're going to have a new video with myself and Bob Powell, who is very prominent financial journalist. I've appeared on TheStreet.com's Retirement Daily. What is it, over 100 times? I think at this is it 100? Pretty close. But my point here is that the idea of having multiple 401ks is going to be a thing. Gig economy, you don't get a 401k. Waiting periods on 401ks, now leaving this lapse, and now you've got to do something during this waiting period. On and on it goes, because what you have is the change of career and jobs then changes the way that you would think through the timeline by which you then have to fill in these other spots. And you can see now that now and only now do we get to the point of all the headlines that make always is on the news, right? So to me, it's kind of perverse, right? Which is, I would prefer all of our effort as people involved in financial guidance of any sort to start with, tell me who you are, tell me what you want. From there, solutions follow. And by solutions follow, this can be insurance. I've spoken about annuities, for example, and their function on this timeline. For those who don't know, newcomers, I'm an education fellow at the Alliance for Lifetime Income, a nonprofit which is used to describe to the public as well as to other advisors about the function and usefulness of annuities, given the fact that the three-legged stool is perishing quickly. Other videos about the three-legged stool well beyond today. And now it comes and it stretches all the way down to savings and investment approach. This is why I don't spend any time saying, buy this Vanguard Ginnie Mae fund, or buy a long-dated Treasury bond fund. I don't spend any time doing it. None. Zero. Because for me, this is about how much risk you either want to take or how much you need to take. Tell me who you are. Tell me what you want. Right? Now you get to the approach. Because I can tell you, as a person who has asked everyday people, and that number hasn't really mattered, meaning what the sum of all their balances was, it hasn't mattered. It could be X, it could be 10X, it could be 30X. Is that when there's a mismatch between tell me who you are, tell me what you want, and the numbers here, and what now I can look underneath the hood. I say, do you understand that this is not matching with what you said who you are and what you want are? It doesn't, we gloss over this. We gloss over this, and why? Because we've had a smooth ride for a very long time. Absent a few bouts, which are painful, by the way, and Again, I'm not going to revisit every last video. I'm not going to every last portion here. I'm trying to find it. Yes, here it is. Right? In other words, given what's going on in the world, you still have this concept of sequence risk here. And the point here is if you're down, it takes you a lot, even if the average is reported to you, right? You're here in the there and now. You have bills now. And then things are going to change. For example, let's say you get news from a doctor that you did not want to hear. Now you've got a bill at the same time your statements are lower, more volatile. My point here is that not enough attention has been made here up front. Up front. What are you trying to do? Tell me who you are. Tell me what you want. Now drives your savings investment approach. This all gets glossed over because it's far more, fun to talk about whether or not Nvidia is going to go higher or not. Far more fun. I get that. Long windup, but now we'll get to the point, right? Because I will deal with, now that, since it's my channel, I get to go in the order that I want, right? So as a result, right, 26 minutes here to tell you how much more important the setup is. From there, we can deal with the facts we don't control. And I'll describe those. I'm so committed to this, in fact, that, the reality is that I'm from the playing field of financial markets at the highest level. I'm very confident in saying that. This is not RIA wealth management. No. I've been on the playing field with the world's largest managers, including central banks. Okay, so when I'm talking about volatility, I'm not with the crystal ball. We are definitely going higher. We are definitely going lower. I'm not making that statement at all. I don't want to be misunderstood in this way. What I am very comfortable in saying, however, is that this blue curve down here, right, has gotten much wider. Right? In other words, even if the average were the same, this curve is now flatter and wider. What does that mean? That means what you thought was a very unlikely event has now become much more likely. Much more likely. And I'm going to quickly review that this is not any different than the breadcrumbs that I've left here. I even, before today and preparing for today, I woke up in a panic because I lost an hour of sleep. I took snapshots. I did copy and paste of dates that I mentioned these facts. So you can, people who are readers of the newsletter, jo.substack.com, they know what I say, which is stocks for show, bonds for dough. Why do I do that? Because interest rates affect cost. So from that first point, now you can see how they all attach. Bonds for dough. And this is not the first day that I've talked about inflation and its eroding effect. Here is a video that was that I created and an interview. I was interviewed by one of my other great OGs, who's Art Lewis. And this video I talked about the effect of inflation and the fact that I said at that time, and this video actually occurred when well before the market declined in 22. Interviews just probably still not fully probably fully not still not fully realized. And basically what I was saying was that the effect of inflation wasn't reflected in asset prices. ERP. I should have not used this abbreviation. Even then, I was pointing out in December, equity risk premium, and the question boils down to, are you paid enough to accept the risk of stocks? Because this is now negative. And that at that time, December, that other stuff still attractive because interest rates higher. And now they're notably, almost shockingly lower. Right? So my point being that the world is going to change. You could have known, hey, I'm missing something over here. I've got holes here. Markets can also hand you opportunities if you understand how that particular set of stuff works. So I can tell you candidly that I've seen setups and said, hey, we're short some particular element. Mr. Market has handed you a situation where this now has improved. And by improved, got cheaper. I'm a cheapskate, right? So I'm a cheapskate on behalf of my clients, in which case, now all of a sudden, this opportunity, which did not exist before, does. Roth IRA, for example, compared to 5 years ago, notably better. Why? Interest rates higher, meaning tax-free income dollar amounts greater. I've now summarized like 3,000 Roth IRA videos on YouTube. So sorry to them. My point here is that the investment strategy has changed, and here is breadcrumbs here. I kept leaving these breadcrumbs all throughout the days, and I don't know I didn't put them in the right chronological orders. So you could see here, I was saying retirees can be helped here. January. The 10-year note was at that point in time, the 10-year note was what, 4.5 to 4.7? In fixed income markets, in interest rate markets, this looks like a small difference. It looks like only 0.2%. It's a huge percent. And it's a huge percent. Let's see here. I'm very sure we got this one. Another one of the areas that I'm pointing out, right? Because the interest rate, which is this R, is, you can see it. This is the power of compounding, squared to the third power, to the fifth power, to the 10th power. And now all of a sudden, this is the power of compounding, because that's the way that costs work. It's kind of like the reverse of credit card debt, right? You want your freebie of financial guidance? You don't need to look any further than today that excessive credit card debt should be number 1A in terms of reducing cost. Absolutely. Because let's just say instead of paying off your credit card debt, you want to invest in the stock market. Nobody would tell you that in a year, my expected return is going to be 28%, which, credit card can easily be. Right? Whereas the cost of the compounding of credit card balance is certainly going to be this 28%. It's not close. I've now summarized another 3,000 videos on YouTube. My point here, and on we go, and you could see what I said on November 2nd. That the soup was complicated. And almost certainly, and you can see the timestamp was November 2nd, even before the election. Even prior to knowing the outcome of the election, that inherently just a change was going to be the source of volatility. And at that time, what we had was me thinking through interest rates and saying, this is another source. So it's not one of my clients said, you keep saying you don't have a crystal ball, and then what you say turns out. Yeah, this is to me, I call that just me pointing out, the obvious, right? This to me was not being predictive, right? Predictive is, Tesla is going to go up to $350 a share. That's predictive, right? Here, this is okay. The environment looks to be like there's going to be more volatility. Looks to be that there's going to be more volatility, and I'm, fumbling back over here, right? Which is, not coincidentally, a return to this. Again, remember, and that's why I've got this permanent in red. Nothing says it can't continue lower or higher. Nobody complains when higher volatility leads to better results in financial markets. Nobody complains. You get the flip side to that. You get to the flip side of that, and now you've got all this, markets in turmoil. All right, where are we today? We fast forward now. We're not going to use that much more time to summarize, but I'm going to show you the illustrations here now. This gives you an idea, right? The year to date in almost all equity markets is now negative, and here is a very good look. Here's a very good look, and let's get this out of the way, your way. Here it is. So this is the S&P 500. For those people who know nothing about financial markets, S&P 500 is the most diverse of the indices, I would say. It is market cap weighted, meaning that Jay's Rib Shack has a far lower influence on this number than Apple Computer. Rightfully so. Jay's Rib Shack is the location of the world's most delicious ribs. Doesn't matter. Still not as big as Apple Computer. So you can see here now, year to date, 1.9%. And it is not the actual number that is telling you about the volatility. It is the speed. February 19th, this is the way the numbers looked. There we go. Plus 4.46. And now down to year to date 1.89. So what is it? 4 or 5%? And you can see that the NASDAQ, which is the yellow line, went from plus 3.86 to minus 5.77, minus 10%, because the reality is Friday, it was notably worse. So you've had a 10% drop close to close from this date here to this date here, which is, for the record 5% drop from the all-time highs ever. Other surprising things, and what I did not include, which I am now going to start to include, is the fact to say that things can be random and unpredictable. There's no version of the real world, candidly, that I would have told you that Europe, back into dollars, would have outperformed the United States in 2 months and a week, 9 weeks, by 20%. 20%. Stunning. So now we got Europe trading like a penny stock. And you'll see why, and that is even with the idea over the maximum period, you could see what's happened if we just keep drawing out to the five. This maximum is probably too far because we're not sure. 1985, you can see what has happened here. Right? Europe is less than half of even the Russell, or half of the Russell, which is also done terribly. A full year, small caps, Jay's Rib Shack, and all my competitors, is nothing more than break even for a full 12 months. Nevertheless, very stunning. These are stunning, no question. That this a degree of outperformance is almost unheard of. Almost unheard of. You can see by the lines that this has been going on here, and it's pretty recent because you can see here at the end of, so this has literally happened over 9 weeks. It's fair to say that volatility is back. You can get this from a single statistic, and that is the VIX. Here it is here. So VIX, you can see what I put in Google on Google search, right? Which is VIX Google Finance. VIX is a measure of how volatile it is the world will be, or how volatile the market believes the future will be. Very important. It's not a statement about how volatile it has been. It is a statistic which says in the future, this is for 1 year, here's how volatile we believe it will be. In other words, it's making a statement about how flat this curve will be. Okay? So now you can see that there are actual facts and actual market prices, because this number here, 23.37, is the input to this formula here, which I've shared on the newsletter. This is the Black-Scholes formula, which is the options payout diagram. Here's what that payout diagram looks like. This is oh yeah, by the way, you can now see the tie back to all the other topics on Jay's Corner. Health insurance. Health insurance looks the same, right? You're paying the premium, and if you get sick, you get the benefit, which is this hockey stick-like shape, right? So Jay's job here is to minimize the cost and to have the sharpest angle on the hockey stick. Well, that number, by the way, which looks like this strange, statistic that looks irrelevant. Nope, it's not irrelevant. You can see it down here. Volatility down here, right there in the formula. It's telling you the degree by which this blue curve is wider and flatter. So when it goes lower, that tells you that the blue curve is narrowing. And or that the market believes that the blue curve will narrow in the future. And you can see what has happened here on the graph. Oops. This may be best view of all. I realize that. But you can see this graph right there at the bottom, which is, you see tremendously higher, right? Notably higher here. This is a huge amount. In this space, this is a huge amount. And to give you an idea further, we're going to get a little bit nerdy here. Maybe some of you think that we already crossed over that, but this is how it translates. This is 23.37% on an annualized basis. Here's the math. So we took the 23%, right? 0.23. We multiply by the existing S&P 500 level, which is here. And then you divide it by the square root of t, and there are 252 days, trading days a year. And the result is 83.6. To give you an idea, 83.6 represents the number of S&P points per day that the market is telling you that it expects to move intraday. To give you an idea how much that is, right? Let's take this number here, right, and divide it by the close. In other words, we're expecting, 1.4% move every single day. 1.44% every single day for the next year. In other words, 83 S&P points is 1.43. It's not being a predictor, right? It's not saying that the prediction is going to be 100% accurate. No, right? In other words, just like this, right? No one is saying with absolute certainty that it's going up here or going down here. It's saying that on average, that what this is predicting is 23%, and 23% is 1.44. 1.45% every single day. So the Mr. Market is telling you, predicting for you, right? Does this matter? Yeah, it matters. It matters because now we loop back down to here. Some of you are taking excessive risk. Some of you have no choice, right? For example, once you've gone through here and you have estimated to yourself, I'm far behind. I'm going to have to take the bumps here I'm far behind. I'm Mr. Perfect, right? You may not have any choice. I have more money than I know what to do with. I'm also in the very, very short run here. I need the cash today because of urgent requirements because my expenses are so high. My point being is that your savings and investment approach, your strategy here, logically, rationally different. Logically, rationally different. I can't determine that. I don't know you. I don't have the set of facts, the context. You haven't told me who you are and what do you want, right? So, the point here is that I'm telling you about inputs. I'm telling you how it works and the things affecting financial markets, but how you actually deal with it is very dependent upon your conclusions here in the yellow box. From there, we can live with the result. Again, it's the central idea on every piece of financial guidance that I would suggest to anyone, which is that I'm without a guarantee on the outcome, right? I don't have a problem with accepting uncertainty or risk. What I have a huge problem with is when people are unknowingly taking risk, either which can be too little or too much. I don't really have a say in that. I don't really have, or what I should say is, I don't really have a predetermined answer for that. I don't have a predetermined answer for that. We would need to know all the set of the correct context so that we can determine whether or not this actually fits your specific situation. One of the books on my Amazon wish list is The Search for a Perfect Portfolio. Great book. What a team, something like 10 Nobel Prize winners, and basically the my takeaway from it is not a single one said, here's your single perfect portfolio. That one I definitely would agree with. Okay, that's all I got here for today. Within the hour, as I had hoped. I'm going to try to keep them all within an hour. I realize that I go fast and want to give you a very good preparation here and reasoning without being, Rumpelstiltskin, that how complicated it is, that we could have predicted. There are real reasons for the uncertainty. We've got a message from public officials telling you that it's not likely to decline. Mr. Market is telling you it's not going to decline. The question is whether or not you understand that and have the appropriate amount of risk and savings investment strategy to match your particular situation. Be sure to like and subscribe the video. Hopefully, other people will get something from it. Hopefully, you have today. jo.substack.com. Always at least subscribe to the free version. There's a paid version for those who need an extra layer of information. Have a great Sunday, everyone. Thanks.